Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, September 4th, and you are tuned into On Trend, the show designed to keep you on the right side of the trend. So today we're going to focus again on finance and the banks because it looks like the cup is half full basically. We'll see how a downturn in TLT might affect finance and banks as well as utilities and REITs. Then we're going to turn to oil. We'll look at some European indexes that are weakening. We'll go over the Q&A, and I've got some charts to watch. And just a friendly reminder that you can see this show at 10:30 a.m. Eastern Time on Stock Charts TV, and then it repeats right after at 11 a.m. Eastern Time on Tuesdays. And you can scroll through the schedule by using the arrows there on the right and the left. XLF, the cup is half full. Now, when we look at industrials, we can see even more strength than in finance. And of course, not as much strength as technology or consumer discretionary or healthcare because they are at 52-week highs. But we can see that, this period of lower highs has been reversed with higher highs, and we even have a higher low there. So industrials are strong enough, and the glass is clearly half full here, and I'm leaving support at 74 for now. I'll reevaluate on a close below that level. Now, if we go within the finance sector, I think one of the strongest parts of this group would be insurance. Here is the insurance ETF KIE, and it was going nowhere from October until June, and then it started taking off in July and got that breakout, and then 52-week highs here in August. So clearly insurance is attracting some money right now, and this broken resistance zone turns the first support zone to watch. And as with finance and industrials, I'm watching the immediate upswing for the first clues, and if we close below 31.25, then I'll reevaluate there. So I was warming up to regional banks in July, but they kind of flatlined in August because we had this decline the last 2 weeks. But I still think the overall trend or trajectory is up. And I think regional banks and, semiconductors and a lot of these ETFs are kind of struggling because they have a number of components that are weak, but they also have a number of components that are strong. And that's part of this bifurcation that we're seeing in the overall market. We've got 2/3 of the market I think is strong, 1/3 is weak, and that's kind of limiting the upside. But, you're in a bull mode as long as 2/3 of the market is strong, because that is more than 1/3, obviously. When we look at regional banks, clearly we're making higher highs and higher lows over the past 9 months or so. And we're getting a bounce off this support zone here, a little bit of a pullback there, and I'm looking for maybe a breakout there at 64 to open the door to new highs for regional banks. Now let's see the relationship between banks and the finance sector with the long-term Treasury Bond ETF. Now in the next segment, I'm going to talk about TLT because it is backing off of resistance. That is the long-term Treasury Bond ETF. And if TLT moves down, that means long-term treasury yields are going to be moving up because bonds and treasury yields move in opposite direction. But before I look at TLT, I just want to explain the relationship between TLT and XLF, the finance SPDR, and the regional bank SPDR. And I'm going to do that with that correlation coefficient. So I've got a weekly chart here, and there you can see TLT unadjusted, and I'm going to go over why I did that in a little bit as well. But I think the long-term trend is down for TLT. All right, you peak there in the middle of 2016 roughly, and you had a little bounce in 2017, broke down in 2018, and now hitting resistance here. So if TLT does move down, how is that going to affect finance? Well, it's negatively correlated with XLF, and that means for the most part, when TLT moves down, finance moves in the opposite direction, which is up. So if TLT moves down, we would expect XLF to move up because of this negative correlation coefficient. This is a 13-week correlation coefficient with the black line. The red line is the 13-week EMA just to smooth it. Now, we're not looking for, granular analysis here and pinpoint signals. No, we're looking for the broad stroke here. In other words, how does TLT, or say, how do rising interest rates affect finance and banks? And evidently, if TLT falls and treasury yields rise, that's going to be a positive for banks. Now, if we scroll down this chart, we can see that that is going to be a negative for utilities and REITs. So we've got the correlation coefficient for TLT and XLU top there. And so that means when TLT moves down, utilities tend to move in the same direction, positive correlation. So if TLT moves down, utilities are a bond surrogate, so they could move down as well. And the same with REITs. All right, you can see a very strong positive correlation between REITs and utilities with Treasury bonds. So that's something we may want to be watching in the coming days. So as I noted, TLT is backing off of resistance, and we'll also look at IEF and the Treasury yield charts. Now we look at the Treasury bond ETFs, IEF and TLT, and they are unadjusted, which means I have taken out the distributions, and I will deal with that in the Q&A coming up. But what we see here is resistance, all right, coming in for IEF around 103. And we had a little back off last week. We bounced a couple days, and we're down in early trading today. So maybe we're going to continue lower here for bonds. And if you look at IEF, the same thing. Sorry, TLT down here. A lot of resistance in that 122, 123 area. The sloping down 200-day moving average, the 52-week low here. So it looks like this counter trend bounce is turning as we move lower now. So that means TLT could be moving lower and Treasury yields could be moving higher. All right, this chart here goes back a couple years and it shows the different Treasury yields. All right, you've got the 30-year yield at the top around 3%. You've got the 10-year yield at 2.86%, 5-year yield, 2-year yield, and then the 3-month yield is above 2%. But clearly the 3-month yield is just on a steady rise, as is the 2-year. It fell back a little bit here, but might be turning up now. But you can see that as we go from short to long, the rates get higher, the yields get higher, and that means we have a positively sloped yield curve. Now in the indicator window, we have the 10-year less the 2-year, which reflects the yield curve. And you can see that the difference between these two has been narrowing. So that means the 2-year yield and the 10-year yield are getting closer. But still, it's positive. All right, the 2-year yield has not gone above the 10-year yield. So we don't have an inverted yield curve. They're not that close, really, when you think about it. And if we look at the 5-year less the 3-year, all right, that has taken a downturn and narrowed as well, but we still don't have an inverted yield curve. And if you want to know how I created this chart, scroll down to the bottom here and I'll show you. I use the price same scale as my overlay. So I've got price same scale and I got UST 30-year, and then I've got another one with the 5-year, the 2-year, and the 3-month. And then I added a couple indicator windows for those yield curve representations. Oil is extending its uptrend, and we're going to also look at XLE, XES, and XOP. So oil is on the move this morning, up around 1.5% in early trading, and here is just a clear uptrend for USO, and you can see a correction along the way. The last was this wedge pullback, which was duly noted. RSI almost hit 30 on the pullback there in mid-August, not quite. And you can see how it just gapped down and moved sharply lower and then rebounded. And so this is what kind of mean reversion is all about. It's like sticking your hand out to catch the falling knife. Look here, we had this gap down and sharp decline in mid-June and then a rally. So that's what we're getting now. We're getting a rally and a breakout in USO, and oil remains one of the strongest charts out there, if you will, because it had a 52-week high in July and it's going to challenge that high pretty soon here. All right, here is XLE, and XLE highlights a great difference between, say, pattern breakout traders and mean reversion traders. If you see here, we've got a big surge here, and then we started correcting. And RSI finally moved below 30 in mid-August and then right back above. And that was the mean reversion signal there, right, with that move above 72. And so, you know, it looked like the bottom was falling out here, but then we immediately reversed. Now, if you're a pattern trader, you would see a big advance followed by some sort of sloping decline that looks corrective in nature. And then for the pattern, the breakout would be around 78. Now, personally, I would rather be active down near the August low than near, say, the July high. All right, even though a breakout could extend, you could go to the mid 80s. I just think mean reversion has become more my cup of tea than, say, breakout trading here. And that's the big difference. You know, pattern traders would have seen a big support break, but then you would have seen a bear trap. So that was the same there with that mean reversion bounce. But I think with oil moving higher, I think there's a good chance that XLE continues higher as well. Now here's XES, Oil and Gas Equipment Services, SPDR, and there you can see the top 10 holdings, and it's a relatively equally weighted ETF. You don't have the bigger ones like Schlumberger and Halliburton and Baker Hughes dominating. You can see Halliburton's about 3.71, Schlumberger's about 3.5%. And I'm going to show those two charts next because, man, they look terrible. And that's probably what's weighing on XES. It's kind of like that. When I was talking about that bifurcation, you know, you've got some strength within the group, but you've also got some weakness. And you can see overall XES has just been range bound for about a year. And you had the big surge there in April. It looks like a correction possibly because you retraced 61.8%. Looked like you were falling off a cliff here in mid-August along with oil and XLE, but got this bounce. And now we backed off to establish resistance. So there's the area to watch for the wedge breakout. And that could reverse this slide here and argue for a challenge to resistance in that 19 area. Here is Halliburton, and look at this fall that Halliburton has had over the last few months, and that's a 52-week low there, so it's very close to a 52-week low. And in fact, it just hit a 52-week high there in January, and now almost 9 months later, it's near a 52-week low. So when you sit down to a chart, first thing you ask yourself, is it on trend? Okay, if it's not on trend, is this decline a correction within a bigger uptrend? And you can clearly see on the Schlumberger chart that, you had the big breakout, and then you had the pullback, and this breakout here in April should have held, but it didn't, and we fell back. And so you can see we're back near these lows, and so Schlumberger is not on trend, and this decline that we've seen since May does not look corrective in nature. Maybe support or hold, but I'd say move on to another chart. This chart just doesn't look on trend enough. Now, the oil and gas exploration and production ETF is actually stronger than XES because you can see that we have a 52-week high there in May and again in July. And then we got a pretty sharp correction. You had the plunge with the rest of the energy-related ETFs and stocks in August. But now we've got a breakout of sorts working. And there was that oversold signal with the move below 30 and above 30. So XOP looks stronger than XES. So if you have any questions, comments, or feedback, you can always send an email to askarthur@stockcharts.com. I cannot answer all of them, but I do promise to read them and consider them. And having said that, I've got 3 questions that I would like to address. Why do I use it unadjusted TLT? What do I think about trading breakouts versus mean reversion trading? And why doesn't USO track West Texas Intermediate crude very well? Let's look at these. So why do I use unadjusted data for TLT? Well, I've got a chart here and it shows the dividend or the payments that TLT made here. And I'll show you how to do that just a second here. But so this is the regular TLT chart with the dividend data added back in. So that means when they go ex-dividend, Stock Charts adds that back in because actually you received that money if you own TLT. It wasn't like you had a loss. You received it, so it shouldn't be subtracted as far as the total return of TLT is concerned. Now, it does do different things to the charts depending on whether you have the dividends added back or not. So you can see that here is a point here. We had a close up when you added the dividend back in. But here we close slightly lower without the dividend. See, I've got underscore TLT, and this is unadjusted data in the lower window. And we can see this 200-day coming in here. And on the unadjusted chart, we did not clear the 200-day. But if you look at the top window, you can see on the adjusted data, we did clear it. And when you adjust with the dividends by putting them back in, it puts a slight upward bias. And that upward bias depends on what you're looking at. If you're looking at a tech stock, it probably doesn't make that much of a difference, or a biotech. But if you're looking at a utility or a REIT or a Treasury bond ETF, it is going to make a bigger difference. You can see here that the one that is not adjusted for dividends is above the 200-day, but the one that is adjusted, taking out the dividends, is below the 200-day. So which one is better? That's, of course, the million-dollar question. Well, I went and looked at the futures charts to see which one was better. And you can see here there's a clear resistance zone there at 122, 123, whereas here we got kind of a rise working there. So it's not quite, maybe TLT is not as strong as it would suggest when you add back the dividends. So remember these highs here. Now let's look at the futures chart. Now I know this isn't very kosher, but here I am on .com, and this is showing the futures for the Treasury bonds, the September Treasury bonds. And you can see there's this resistance zone that it's hitting, and you can see a move down over the last week, and then this is this morning's price action. Treasury bonds are moving lower. But I think when you compare these charts, that this chart looks more like the unadjusted TLT chart, and that's why I would recommend using unadjusted TLT if you want to analyze price action. If you want to look at total return, you definitely need to add those dividends back in. So how did I put those distributions or dividends on the chart? Well, if you scroll down to the chart attributes section, there you can see in overlays, one of the options is events, and I just chose all. And that will show all of the events, distributions, dividends, splits, or any kind of corporate action where there was a payout. Now I've got one more trick to show you when it comes to TLT and the 30-year Treasury bond, because that's what it mostly applies to. Sure, it's a mix of longer dated Treasury bonds, but the 30-year yield best matches up with TLT. So in the top window, I've got unadjusted TLT, and you can see that chart, of course, shows the resistance zone in that 122, 123 area. Now, in the middle window, I've got the Treasury yield, but it's 1 divided by the Treasury yield, so it's showing it inverted. All right, that's to make it look like the TLT chart above. So it's the inverted Treasury yield, and you can see it matches up pretty well as far as resistance and the 200-day. You didn't get above the 200-day here in May. All right, you got above it there in July, and you moved below it here in August. And I'm not using that for signals per se. I'm just showing you how they relate. And then down in the bottom window, I've got the real 30-year Treasury yield. All right, and see here is inverted in the middle window. And you can see that it matches up in the inverse. You didn't break below the 200-day there. You broke below it here, whereas you broke above it here. And you turned back above it here in late August. If you want to chart that, you can go down to the bottom here, and you can see I added price $1, $TYX to get the inverse of any chart, any symbol. So what about breakout trading versus mean reversion trading? Well, I've got an example here with Hack. You know, I could go and I could show you a number of breakouts that worked and made lots of money. I could show you a number that did not work and lost money. Same with mean reversion trading. I can show you ones that worked and ones that didn't work. And basically you have to go through the charts and figure it out for yourself, because some people like to trade breakouts and some people like to trade mean reversion. For instance, you can see there was a head and shoulders, inverse head and shoulders into November, and you got the breakout there. There was the throwback, and you got a second chance with mean reversion. And then if we look at this pullback here in March, we didn't get oversold. We got into the oversold zone, but you could have drawn a flag and had a tighter breakout here. And I like those kind of breakouts, all right? When you have a pullback and you have a clear resistance level there and you break it. All right, if you look here, we've got kind of a sloping consolidation or some sort of consolidation, and we've gotten a breakout here with that move above 40. Now, that's not my type of a breakout for a signal. All right, sure, we've broken above resistance and we've hit new highs, and that is bullish, but as far as a signal, it wouldn't be my kind of a signal. When it comes to the signals, I would prefer a mean reversion signal when RSI becomes short-term oversold, and then look for some sort of a short-term breakout, all right, instead of a big breakout like this. And especially as I noted in the weekly market review and outlook, things are getting extended. We're heading into September, October. Volatility, uncertainty could pick up. So now might be a good time to not play the breakouts and maybe tighten some stops. So why doesn't the U.S. oil fund, USO, track West Texas Intermediate crude very well? Well, I think if you want to know something about an ETF, you have to go to the provider's website and read it right from the horse's mouth on what that ETF is, what it's tracking, what are the holdings. All right, so go to the uscfinvestments.com website and you can read there. And here in the middle of this paragraph, it invests in oil futures contracts and other related futures contracts. All right, it may invest in forwards and swap contracts, and they may be collateralized. Well, there's a lot going on there. All right, there's a lot of management required. There's a lot of rollovers required. So this is not like owning a bucket of or a barrel of oil in your backyard and just holding it and watching the price go up. No, these are futures contracts, and oil requires storage. And so that's why you have backwardations and contangos and all this other stuff. So USO is not just like a physical barrel of oil. All right, it is a basket of all these things made to track oil. So it has a tracking error. Now, USO tracks oil pretty good for the short run. All right, definitely for a few weeks to a few months, you're going to be okay with USO. It's when you get into a year or longer that you're going to have issues. And if you look at West Texas Intermediate crude, well, you can see there's the high in 2015, the latter part, and it exceeded that high in late 2016. USO did not come close in the middle, and USL, which is the longer-term U.S. oil fund ETF, didn't break that high until the early part of 2018. And then if we look at that 2015 high in the low 60s area, we can see that West Texas Intermediate broke it there in January, but USO is still not even close. All right, so it's got a big tracking error, and the longer the time frame is, the bigger that tracking error is going to be. So you can see from the low in 2016 to the current high, USO and USL are up around 100%, whereas West Texas Intermediate crude, which is basically the equivalent of spot oil, it is up 186%. So the bottom line is use USO for short-term trading. Now I want to turn to Europe because there is some weakness coming across in Italy and Spain, and Germany's got a bearish reversal pattern forming. Now, gold and other hard asset ETFs like silver and copper tend to track their underlying quite well. And this is spot or the continuous contract for gold in the top window. And this is the gold ETF in the bottom window. And you can see pretty much, you know, the lower lows match up there in 2015. Then we got the higher high in 16. The 18% advance, well, in continuous contract was a little bit less than the GLD advance, but it's pretty similar. You can see these charts match up. So you can use long-term analysis for GLD or silver. They don't do copper anymore, or there's something happened with the JJC ETF. Here is France, and France is stronger than Germany right now. There's still an uptrend working in the French index, the CAC, and you can see we've got higher highs. We got a little bit of a decline, but that looks like a pullback within the uptrend, and maybe it's turning back up. But if we break support here, then that would be a negative for France. Now, the real weakness starts when we start looking at Italy. All right, this is the Dow Jones Italy Stock Index. And we can see that, you know, it hit a new high there earlier this year, but then fell really sharply, consolidated, and then broke down again. So this one is looking pretty weak. I've got 26-week RSI, and it's been below 50 since May there. And when you're below 50, that tells you that the cup is half empty for Italy. So that's a pretty sharp decline that Italy is working with now. Finally, we have Spain. The Spanish index here, you can see that it peaked back in May 2017, and it has been falling for well over a year now. And this is one of the weaker indexes in Europe. You know, maybe you have a resistance break turning into support, and that's probably a 50 to 62% retracement there. But, you know, we haven't seen any strength, and we need to get above 10,000 to get any kind of a breakout in Spain. Now, I'm not going to say this is going to affect the U.S. markets, because the U.S. markets are their own markets. All right, we need to watch the U.S. markets for clues. But yeah, as we head into September, October, and these European indexes are looking weak, that could give way to a little more volatility in the coming weeks and months. All right, now let's look at some charts that are worth watching. First, we have the Russell 2000 Small Cap ETF, and it broke out of an ascending triangle here with that move above 170. It was down a little bit on Friday, but this resistance zone becomes the first support zone. So if we do get a pullback, I would watch this zone around, say, 168, 170 for potential support short term. The communications sector is not having a good time here. You can see you had that little breakout, but then we failed near that 50% retracement. And look at those two sharp declines, and we're breaking the wedge. And this sector is going to debut on September 24th, and it's going to be around 10% of the S&P 500. The home construction ETF remains one of the weakest industry group ETFs out there. It has been declining since January there. You got that little gap and surge, and this may be a wedge correction. If you do a 30-minute chart, you'll see we're near that 61.8% retracement, but we need to get a breakout there around 38.4 or so to get this wedge reversed and get a challenge on resistance. But clearly this one is not on trend. So a couple of banks here to watch. This is Bank of America, and there's that nice surge that we got in July and a breakout there. And now we've come back to the breakout zone, which may offer support here as maybe a triangle forms, and a breakout at 31.5 would be bullish here. Next up is Fifth Third. Now I say, is the stock on trend or not? Well, it's in a downtrend over the last few months, but it could be a correction after this big advance. And we're firming, but we need to get a breakout at 30.5 to reverse that. And finally, we have JP Morgan, which is also forming a triangle. You know, got the breakout, but it could pull back to broken resistance, which turns support in that 110, 112 area. So I'm going to start off with the finance sector, not because it is the strongest trend out there. Clearly, it's lagging some of the other sectors like technology and healthcare because it's not at a 52-week high. But I think it's one of the more interesting sectors right now, that along with XLI, because it has really perked up since July, and I think the cup is half full for XLF here, and as I'll show, XLI. And if we look at the chart here, you know, as I've said before, we had a big surge to a 52-week high, and then we had a long correction. We found a lot of support here with 4 bounces in that 26.5, 27 area, and then got this little breakout move here because we got a higher high. And so that tells me that, you know, this series of lower lows has now been changed with a higher high, and that suggests that we have an uptrend working here in XLF. Also, look at the gap we had down 2 weeks ago. We filled that right away and went to a higher high. So I'm going to put support at 27.5 to watch this swing right here. And as long as we stay above it, I will keep the glass as half full for the finance sector. And that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.